Now I'm going to introduce industry icon and good friend, Alan Haig.
But I want to thank everyone for coming today. It's really a pleasure for me to be in this room with many of you that I've met now going back decades. I think 1996 was when I started the business, and that's when I met Don Reese, who's in here, and I have the pleasure of now having met many other people in this room. So I wanted to start with a little story about why it's important for all of us to be in this room together, because it's these contacts, these relationships, these exchanges that lead to success. So can I get the first slide up, please? So you're here at this forum and summit. I want to tell a story about last year at this event. We had Jim Godfrey, who's the head partner. Jim, okay, thank you. Had a client interested in possibly selling his business. And that gentleman owned 2 Chrysler stores in the Carolinas. Jack Saltzman. Jack, are you here? You mind just standing so folks can admire you? Please, another slide. So that's Jim Godfrey. Next one. We got Jack Salzman. Next person we had Don Reese. Are you here? If you could please stand. Don was representing a new entity called Franchise Equity Partners that had raised $1 billion to invest in franchise businesses like automotive, restaurant, and beverage. Don presented their interest in making minority investments in leading dealership groups. So Jim introduced us at that conference. That's why I met Jack. And then we ran a process and identified the Parks Automotive Group as the buyer. Adam, I haven't seen you yet this morning, but are you here? Great. If you don't mind just standing for just a moment. And this transaction was financed by Truist. Jason Smith, are you here? Jason? Truist provided the debt and the equity, or a portion of the equity capital for this investment because it's Franchise Equity Partners that has invested with Adam and his company to fund this acquisition as well as hopefully many others. What I didn't realize is there was another group, which is Crow. Jody, you were here a moment ago. Crow did the due diligence for the buyer and also introduced, I think, the buyer to Jason, Truist. So these connections matter. And I'm confident, those of you who are interested in buying or selling, if you're in this room, you're going to be more successful. You're going to have a greater chance of transacting soon rather than struggling, because M&A can be tough. So thank you all for standing this time, and I just want to give them a round of applause on their success. Okay, I'm going to save a lot of the data that I often give at these conferences for our friendly economists, Jonathan Smoke from Cox and John Murphy from Bank of America Merrill Lynch, that have hopefully a lot of good information for us. I've been doing my informal canvassing of CFOs and dealers recently, and I'll share that informal poll in a minute, but this is still the big story in our industry, right? We have new vehicle grosses that are almost triple what they were before the pandemic hit. So you can see the 3 bars there on the right. These are the first 3 quarters of 2022. We don't yet have the public company information. So my data is a little bit aged, but nevertheless, you can see the trend peaked earlier this year and starting to come down. So the question is, how far will it come down and how fast? And that's something that I'm hoping we can get information from Brian DeBoer and the economists as well as Tom Dahl to get their perspectives. But right now, I think that new vehicle dealers are still enjoying close to record profits thanks to this one department. Used vehicles, obviously there's been stories of big hits that dealers have taken because the wholesale market has come down significantly from its peak. I think our hope is that those hits were taken in the 3rd and 4th quarters of last year, and dealers are now out buying cars and able to get margins consistent with what they have in the past. You can see there wasn't nearly as dramatic a run-up in gross profits on the used side like there was the new. So if there's this one-time correction, I don't think it's going to have a devastating impact on dealership profits. Fixed operations has been fantastic. It's a little bit counterintuitive. You think, hey, there are fewer units in operation, but my service department's never been busier. And I guess the reality is, if you can't fix your car, if you can't buy a new car, lease a new car, you have to keep your existing car on the road. And fortunately, a lot of those customers that own vehicles that are older are not defecting to third-party repair agencies, right? They're coming back to the dealer because they trust the dealer. They like the output that they get. So we're watching this carefully. Obviously, this is a big source of profit for dealers. And one topic we're going to dig into with some of our speakers is going to be EVs and what could be the potential impact to service departments. So far, it seems to me that EVs break a lot. Has anybody seen the stories about Tesla, the challenges that they've had? I've heard stories about Nissan Leaf being acquired for $12,000. The battery costs $10,000. So what's the real value of these over time? There are going to be some good questions for us to dig into. The net of the new, the used, the fixed, and strong F&I is that dealership profits have skyrocketed. Again, this is based upon public company data that my partner, Nate Klabaha, adjusted into what we'll call traditional dealer financial statements that have rent, et cetera, running them through there. But prior to the pandemic, the average dealership was making about $2 million pre-tax profit, skyrocketed to $7.1 million, at the first quarter of last year. So just a stunning rise and a testament to the strength of the auto retail business model, where if your suppliers are not able to supply you with product, you simply raise the price. You move them over to other vehicles. You repair their cars. So it's been an incredible lift in profitability for dealers, and dealers, many of them like what they see and want more. We'll talk about that when we get to the number of dealerships being sold. You can see a slight decline in profitability here the last couple quarters. And I know we have a lot of CFOs in the room, and as much as we enjoy the front end grosses we're seeing right now, we know that costs are increasing, right? The floor plan rates are going up, cost of supplies are going up because of inflation, cost of labor has gone up, right? So we have great grosses, but now we have a little bit of higher costs that are beginning to eat into some of that profitability. By the way, I think it was mentioned that we encourage questions at any point. Someone here has a mic. Is it Mr. Motter? Do you have the mic? If anybody wants to pose questions, you can text them, right? And then Paul. Okay, great. So I like Q&A at any time during the presentation. I don't think you want to sit and hear a 45-minute monologue. I'm definitely going to leave some time at the end for questions. But please, if something comes up you want to learn more about or you have an opinion, please share it. Oh, would you mind going back one slide, please? So this question about profitability, my informal poll, I talked to an owner last week who has a large group of stores in California, and I asked him, does he do forecasting? Yes. What does he think 2023 is going to be? He sent me the shortest forecast I've ever seen. New down, used up, fixed up, profit same. I talked to another dealer on the East Coast who is predicting flat profits to 22. I spoke with the CFO of a dealership group, one of the top 20 groups in the country. That CFO's prediction was a decline of 15% in profit. I just spoke to another CFO of a large group in this room who's also predicting flat profits from 22. So these are some of the largest, smartest, best informed people in my industry, or in our industry, and I was a little bit shocked to hear how confident they are this year, because we read about all the negative news, right? The higher inflation, the war in Ukraine, the supply chain issues, rising costs, higher floor plan rates, et cetera. But these folks who spend a lot of time looking at all different franchises in different markets, this is not one part of the country, are predicting another excellent year in 2023. So I'm praying they're correct, but even if they're not, if we talk about a 15% decline or a 25% decline in profits from where they've been, we're still going to be more than double where we were before the pandemic for this year. So it feels like it's going to be another amazing year to be in our business, and I hope that all their projections are correct.
Alan, we have a question.
Yes?
If you could repeat it into the microphone, do you have any optics on Q4 profitability?
Do we have any optics on Q4 profitability? We have been looking at the clients we're representing and seeing what their numbers look like, and it's mixed. We have a dealership group, I don't know if Pete is in the room, called in the central part of the United States, had an excellent fourth quarter after an inventory write-down in the third quarter. So that might mean for their whole year they're down compared to last year, but if you look at this point going forward, they feel like they're in the right place with inventory. We have had some clients, particularly on the exotic side, that have had a tough year. Their inventory just didn't come in as they had predicted, and they had a big write-down on some of the inventory. But our limited number of data points is that fourth quarter was good. I don't think the stock prices of public companies have cratered in the fourth quarter. So what we know right now seems encouraging. So here's one of the big questions that we have is the supply-demand balance, right? Price is set at the intersection of supply and demand. I remember that from my economics class. Prior to the pandemic, our industry was selling 17.3 million units a year on average for the 5 years leading up to the pandemic. Since then, we haven't been able to come close to that level of production. So in the most simplistic terms, if we look at the number of units that were sold in 20, the number sold in 21, and the number of units that are expected to be sold this year, if you look at the cumulative deficit over that 3-year period compared to the average of what we were selling before, by our simple math, there's pent-up demand of as much as 8.4 million units. Now, you could say that maybe we were overproducing in that 5-year period before the pandemic. Some of these units weren't needed because they were going to go to rental car fleets that don't exist or weren't being used because no one was traveling during the first year of the pandemic. But let's say you cut that number in half from 8.4 to 4.2. And the production's really not coming back. I mean, it's going to take a while for the factories to restore 17 million units, much less getting up to 19 or 20, which is what they would need to do to eat into that pent-up demand. So I'm hoping that our economist friends are going to come. I'm looking at one right there. He's probably shaking his head at my math. This is terrible. He's misinforming the public. But I'm hoping that they're going to share with us some of their insight about the supply-demand balance. Because I think Jonathan, I'm pointing at Jonathan now because I think I saw some data that said that new vehicle supply has returned to 58 days. But I would say the folks in this room, I'm not sure that they're seeing that. So I don't know if it's caught in the pipeline somewhere, if it's produced but not shipped. But so far, I think dealers are looking at empty lots in most franchises. So we talked about the production declines. Has the demand for vehicles changed? And this chart is my rudimentary way, and I'm going to ask Jonathan and John to give us a better informed opinion. But it looks to me as though that if you measure the demand of vehicles as the miles traveled, it dipped during the pandemic, but it's come back. So we're now traveling the same number of miles per year as we were before the pandemic, but SAAR is 19% below. So the demand is there for transportation. The supply is not. How long will it take for those factories to satisfy that pent-up demand? And how much incremental gross profit will dealers earn during this years-long period? It's going to be years, I think, before the inventory is back into balance. Any questions or opinions? I'm going to ask Jonathan to slap me if I'm way off on this or you have a totally different opinion. All right, I won't steal your thunder, but how about other dealers? I mean, if you have those folks that have multiple rooftops, are you seeing a 58-day supply? Are you still feeling a big shortage? Anybody want to volunteer? We might have to call on somebody.
30 days last month.
30 days supply. And that's for the Sarah Automotive Group that has, how many rooftops do you have?
50 plus.
Sorry?
50 plus.
50 plus. So that's a pretty good representation of franchises in different parts of the country. So 30 days is probably 1/3 the level of inventory that we had before the pandemic on average. Imports fewer, domestics more. So I'll be curious to see what Jonathan has to say for us later. So now we want to talk about buy-sell trends. That's the world that we live in, and we try to understand that market every day. We're talking about the number of rooftops that have been selling over the past, let's call it 10 years or so, 8 years. Prior to the pandemic, we saw about 350 rooftops per year trade hands. 90% of that was being acquired by private dealers, like most of you. It's really only 10% would be acquired by the publicly traded companies. They would buy some stores and divest some stores. They weren't really growing that much during that era leading up to the pandemic. 2020 hits. We had an excellent pipeline going into 2020. We closed a number of transactions in the first quarter, and then the market just shut down in the second quarter of 2020. Many of you may remember that. So any transactions that were scheduled for then were canceled, postponed, and some of them were repriced later and came back in the second half of the year. But in 2021, we had a year and a half of confident buying activity. We saw the level of M&A basically double from the 5-year period before the pandemic hit. So we saw a lot of activity from the public companies. Brian DeBoer is going to be here shortly. He's going to talk about their acquisition plans, and they were a big part of that 216 dealerships that were acquired by the public companies in 2021. But if you look at the number of stores acquired by private buyers, that went up 60%, right, to 491 stores. So a massive year, the biggest year in our automotive industry's history in terms of the number of dealerships that traded hands and the amount of cash, particularly the amount of cash that traded hands. It was a massive year of spending, especially for the publics. Look at 2022, we're still getting a couple of leads coming in about stores that have closed that we don't have in these numbers, but it was another excellent year for M&A. We saw 533 stores trade hands. The publics pulled back significantly, and we'll talk about that, in a moment, why that was. But the private buyers didn't. Dealers in this room were making more money, triple the money that they'd ever made before. What were they going to do with that money? Most of them, if they could, were going to reinvest it in their business by buying additional dealerships. So we saw the number of privately acquired stores go up by 2%, while we saw the public companies basically take that cash and do something else with it. We only saw 34 stores acquired by public companies.
This goes back in a couple minutes, but someone asked if we could do show of hands who thinks 2023 profits would be similar to 2022.
Okay, so the question is, could we do a show of hands and ask folks to raise their hands if they think 2023 profits will be similar to 2022 profits? Similar, let's call that within 15, 20%. Okay, so I would say that that's the majority. I sure hope we're right. Okay, so now we get into the dollars spent on acquisitions over the past few years. And again, this is just talking about dollars spent by the publicly traded retailers because we can track that. It's difficult for us to track the dollars spent by private buyers. But in the 5 years leading up to the pandemic, on average, the public companies were spending about $800 million on acquiring stores in a typical year. In 2020, that number tripled, and in 2021, it went up 11 times to over about $9.1 billion the public companies spent on acquiring dealerships. And they were buying, in some cases, single stores, but in other cases, they were taking big bites. They were buying some of the best-known dealership groups in the country. And the owners of those groups were taking advantage of the market conditions, saying, well, I'm making 3 times as much money I've ever had. My dealerships are worth more than twice what they ever were. I've got an eager buyer that's fully financed, confident about approval. I don't know what the future of the automotive retail business is going to be, so I'm going to choose now as my time to exit. So it was an incredible year of M&A for the public companies, and it was really the first time, that kind of 2-year period, the first time, and I would say dating back to the late 90s, and we saw a significant amount of M&A by the publicly traded companies. And so we're going to come back a little bit about, well, what changed? Why would they take this time when dealership profits were so high and the prices were so high? Why would they want to grow now? Why wouldn't they want to try to buy during a dip? If you look at Q3 year to date, we've got about $1.5 billion spent by the publicly traded companies. If you annualize that, you're at $2 billion. So we've gone down more than 75% of spending. So the public companies have different ways they want to use their cash, and this is part of it. So this is talking about allocation of capital, and for simplicity's sake, we've held out cash that the public companies spend on buying back debt or investing in facilities, which are significant uses of cash, just to focus on kind of investment. So you can see that this is largely the Penske organization continues to invest in truck businesses, but in 2021, dealers were spending about 2/3 of their excess cash on buying stores and about 1/3 on buying back stock. And in 2022 so far, we've seen that flip, right? We've seen the public companies saying, hey, my stock price is down, dealership prices are still up. I can improve my earnings per share if I reduce the number of shares outstanding. And if I have high earnings per share, I'll have a higher stock price, which is what makes my investors happy. So they flipped it, and they spend now 2/3 of their cash so far last year buying back stock as opposed to buying dealerships. So that's the difference between a publicly traded retailer and a private. The private, you can't go out and buy back your own shares back, right? So if you want to enhance your wealth, it doesn't make sense to leave it in the bank where we have, well, for a period of time, we had an inflation rate of 9%. So your cash you're getting a negative yield on your cash. If you could find an acquisition opportunity that fits your strategy, and in your opinion it's probably overpriced, but what else will you do with that money? That's what drove this record spending by private dealers last year. So record by the publics in 21 to record spending by the privates in 22. Can I ask a show of hands in here if how many of you bought a store in the last 2 years? Pretty good number. So you folks here were willing to reinvest that capital back in their business even though dealership prices were at all-time high. So here's a question, and I really like an answer. It's hard to value stores today. Does anybody want to volunteer a formula? You have a question?
I have a question. Do you think the dip in M&A activity has anything to do with the unrealistic seller expectations because of propped up demand and profitability? Yes.
So great question. So the question is, do you think the dip in M&A is due to unrealistic sellers' expectations because of propped up profitability? So I would say as a firm, if we have a challenge, it is trying to provide an estimate of value to our clients, sometimes even before they hire us, where we're saying, hey, the buyer has got to get a return long-term on this asset. And it may be making $6 million today, but it was making $2 million in 2019. The buyer is going to project it returning towards that number at some point in the future. So they can't pay you a full multiple on record earnings and get a return that they like. The bank won't finance it as much as they want. It's not going to be a great investment for them. They'll buy something else or they won't invest. And the seller is saying, well, I don't see any slowdown in my profit. This is going to go on a long time. And for me to give up the future profits that are going to be so high, I need to get paid a full multiple now. So that's the tension perhaps the question has. And we have seen some transactions fail where we have clients that weren't able to put themselves in the shoes of the buyers, or maybe they just didn't really care. It just wasn't worth it to give up that asset because it was producing so much. And they had said, well, somebody will pay me all the money, then I'll sell, otherwise I'll keep it. So there is that friction, and it is partly because it's difficult to value stores today. Because we've had some businesses where people are paying us a full multiple on record earnings because it's a great fit with their organization. It fits their strategy. It may not come up for sale ever again in their lifetimes, and they'll pay what it takes to get it. And we have other folks that are value buyers, and they want to price the business off 2019, and we say to them, you know, you're not going to be successful. No one's going to sell a business today based upon that old price. So this question, how do you value dealerships today? I'm really hoping some of you will pull me across at the bar tonight or at lunch and explain to me how to do it, because it's been a challenge. Okay.
How have rising interest rates affected public companies' appetite to purchase more stores?
How have rising interest rates affected public companies' appetite toward buying stores? I think that's a great question. I can ask Brian. But we clearly saw the decline, a massive decline of spending by the public companies. I think it's mostly attributed to their stock prices, but that's a direct reflection of rising rates. Because the prospective economists have, as you rise rates, the reason why you rise rates is to suppress consumer demand. And if you're suppressing consumer demand, that should hurt auto dealers. So I think that's one reason why investors have sold off these stocks. Although what I was going to talk about right here is that some of that sell-off has recovered. So this is a reflection of the change in total enterprise value on average for the 6 publicly traded companies that we typically refer to. So before the pandemic, the average total enterprise value, which is a value of their debt securities and their equity securities less their cash. Do I have that correct? I think that's right. So before the pandemic, on average, total value, $6 billion. The pandemic hits, we have this explosion of profitability. On average, they were worth $9.2 billion in the first quarter of last year. Then we started to see rising rates, some consumer issues, the war in Ukraine, those stocks sold off, the debt doesn't decline, right? So it's really kind of the stock as the shock absorber and the change in people's total enterprise value. So we saw that coming down. We saw it coming down for about 6 months. But then it stopped coming down. And this doesn't have to do with share repurchase or really anything else, right? So now we're up to, because if you buy back shares, you're not really changing your enterprise value. You just have fewer shares at a higher value. So now we've seen public company investors maybe reconsider the auto business. Maybe they're kind of like the folks that think we may see a 15% decline instead of a 50% decline in profitability. So we've seen a recovery in the total enterprise value for these retailers. And again, we'll ask the economists to correct my math later today. So public investors don't seem to have a terribly negative opinion of the auto retail industry. So that to me also impacts private values, because if we can get the public companies back to buying stores, that's going to enhance the value for sellers. So what is the value of a dealership? In 2019, we were really good at it. And what this chart is showing is that for our clients that sold their businesses in 2019, before they sold, sometimes before they hire us, we give them an estimate of value. Here's what we think your goodwill will be, your blue sky. And we give them a low and we give them a high. And for the dealerships that sold in 2019, the offers they accepted were 98% of the midpoint of the range. So we were almost dead on in 2019. And you know, that's something we're proud about. We don't inflate expectations of our clients, right? If we tell you you're going to get this, that's on average what they got. Now in 2020, the offers that our clients accepted were at 86% of the midpoint of the range. Now, many of those deals that closed, the valuations we had given them were done in the year 2019, before we knew about a global pandemic. So I'm going to give ourselves a little bit of a hall pass on that one, because the people were a little afraid. You guys remember the first half of last year. We weren't sure how this pandemic was going to end up. In 2021, the offers our clients accepted were 106% of the midpoint of our range. So the market was stronger than what we had expected. In 2022, the offers accepted were 24% above the midpoint of our range. So the market was just running even more than what we had thought. So I'm sharing this because we spent a lot of time trying to understand dealership values. And we can look at what, you know, the rearview mirror, what people paid, and we can talk to people about how they value stores. But at the end of the day, you know, the buyer is setting the price. And it's the buyer's optimism or feelings of the future, right? Because that's what they're getting. They're getting cash flows in the future that determines how much they're going to pay today. So we're not seeing any negative sentiment in the businesses that we're selling, even when we're trying to price in a downturn. We still see people, yeah, we know it's going to go down, but we want this asset. So in terms of methodology, yes, sir.
A question, and you can do what you want with this. It might be a little different trajectory, but what would a Carvana bankruptcy mean for the used vehicle market? Where would the inventory go?
What would a Carvana bankruptcy mean for the used vehicle market? Where would it go? Well, there are two types of bankruptcies. There's liquidation, which is Chapter 7, in which case there's a company hired to sell everything. You get the best price possible. And I guess the inventory would go to some of those auctions that they own, ironically. And then there's Chapter 11, which is a reorganization. And my sense is that that company would be reorganized. I mean, it has been popular with a lot of customers. The business model may be flawed, we'll see. So I think that depends upon if they go bankrupt, there'll be suitors. And if the suitors are willing to buy the company, then they're going to want to keep it going. And they'll put in equity capital, they'll obtain additional debt financing, and they'll try to restructure the company so it has a viable future. But if there are no buyers, then the cars will go to the auctions. What impact that will be, I don't know how many units they have compared to the daily sales. I'm going to let someone else speculate on that. Does anybody want to volunteer an answer to that?
Not as many as they used to.
Smaller inventory. Yeah. So we're going to talk about Carvana in a minute, too. I mean, it's an incredible story.
Valuation question.
Yes.
How does one put a value on a young business that has not reached its potential when it's included in a group sale?
How does one value a young business that hasn't reached its potential when it's included in a group sale? So projections. You know, projections matter. If you can say, hey, this is an ad point, it was granted in 2019, we never got enough inventory to really get off the ground, but we have our fixed businesses there. If we got inventory back, this is what it should do. Buyers they're looking for a way to make a deal. And they've also had their own green peas, you know, where they're investing and hoping that better things come in the future. So it's just part of the negotiation. It's part of the sausage making that goes into a deal. You have to do projections on any time you're selling anything to show a buyer what the opportunity could be under their ownership. So it's worth more in the future than it is now. And if the buyer doesn't give you value they think is fair, pull it out. Unless it's in the middle of a campus, the nice thing about these businesses is you snap them together over time, often one or two at a time. You can take them apart one or two at a time. You know, we have a number of clients, some in this room, that have said, hey, I've got 20 stores or 200 stores. Those 1, 2, or 3 in these outlying markets, they don't make sense for us anymore. Let's take the cash out of those stores and reinvest it in our core markets. And if I would say to a seller, if you're going through a process, you're not getting fair value, pull it out. And that'll really call the buyer's bluff a little bit, and there'll be somebody else out there who might give you better value for it. Okay, these multiples haven't changed much since the pandemic. They've probably gone up about a half a turn, 3/4 of a turn on average. I think we're kind of at 4.5, 4.6 on average, blue sky multiple. Now we're at 5.3, I think. You can see that the premium luxury brands continue to dominate. It's their scarcity. People prefer that business model often to some of the domestic brands or some of the lower volume import brands. We've seen a significant increase in Toyota since the pandemic started. I think I have my friends, the Andersons over here, who are fortunate to own several Toyota stores, and I would say that's the franchise that almost every dealer in this room would love to have another of. Subaru is ranked right up there as well. Been another great dealer partner. And we have seen a huge increase in the value of Kia and Hyundai stores because their volume has gone up so much. Some dealers still have a little frustration dealing with those factories and concerns about the future. Otherwise, we would be pushing them up for sure. The domestic brands, hopefully they'll get their production back. I mean, they lost a lot of share during the pandemic. And then, you know, we still have some of these other brands that were low volume before the pandemic. You know, the Acuras, the Mazdas, the Cadillacs, the Lincolns, and the Infinities in particular have really suffered because there's so little inventory coming in. The question is, what do you multiply this against? This charts the progression of blue sky values since the pandemic hit, in our estimate, based upon public company numbers and the multiples that we see and the way that people have been valuing stores. So prior to the pandemic, if a public company could sell a typical store, in our opinion, they get about $10 million in blue sky for it. Pandemic hits, it goes up 2.5 times. So we saw the profit went up by 3.5 times. The blue sky's gone up 2.5 times. The spread between there is the buyer's expectation that things are going to turn back down, right? So they can't give a full multiple on the top price, top earnings ever. They've got to factor in a little bit conservative estimate because things will turn down. And you can see we've got here an estimate. So in 2019, we had a simple formula. Last 12 months times the multiple is typically how most buyers are valuing stores in 2019. In 2020, factored in the pandemic. From some states, the pandemic was terrible. If you were in Pennsylvania or New York, they shut you down. So 2020 was a bad year, so we had to factor in a couple years of average earnings when we were valuing stores. 2021, we're doing the same thing, but now we've got 2 good years and 1 normal year in the average. That's how we saw dealers valuing stores. First half of 2022, the buyers had totally dropped the pre-pandemic figures in their offers. And they were really looking at an average of 2020, which was a good year, but not the best year, and the last 12 months when they were coming up with their estimated earnings that they were going to get in the future and putting a multiple on that. The second half, we saw that same formula, less about 10%. So it's roughly what we saw in terms of the offers coming in. So we saw the market coming down about 10%. And in 2023, we don't know. Is the truth. We have to wait to see. We've gotten a couple offers in 2023 so far in businesses we're selling that were above the midpoint of the range that we'd given them in 2022. So far the market is holding together very nicely. But I'm going to ask some folks in this room. I know probably people don't want to give away the secret sauce, but if you look at the way people have been valuing businesses in the past, does anybody want to volunteer a different formula or say that's ancient history? We can talk later maybe. That's a complicated topic. So there are a lot of risks that we've spoken about. Electric vehicles, autonomous vehicles, new entrants like Rivian or Tesla, and many of those things, they're out of the control of the dealer. There's really nothing that you can do about those risks. But there is a trend going on now that dealers will feel, I believe, but they can do something about, and that's consolidation. So consolidation has been really pretty slow. I started in the business in 1996 with AutoNation, and over a 3-year period, we went from 0 to 200 rooftops, you know, and other public companies were growing really quickly then too. But then, for a number of reasons, the M&A activity leveled off, and the public companies were buying very few stores. You can see that's the blue line at the bottom. Really weren't changing their market share, and there was ongoing consolidation with other top 150 groups, but you can see over time they've gone from around 15% to 25% of the market. That's over 12 years. So this market is still far more fragmented than almost any other industry you can think of in the US, where the top 150 players only have 25%. It's pretty small. So why hasn't auto retail consolidated faster? And a big reason, which I didn't understand, I wrote the business plan for the new car company for AutoNation in 1996. And my business plan was a straight MBA textbook thing. Economies of scale, national brands, best practices, lots of capital that was cheap. With that, we could build a company that would outperform smaller operators. That's what we were taught in business school. And almost none of that was true. You know, there are almost no economies of scale in this business. If I have one Ford store in the mountains of North Carolina, I'm going to pay the same price for that F-150 as Brian DeBoer is going to pay for an F-150 for any of his stores. I got to pay the market price for used. I have to pay the market price for real estate, utilities, labor. All those things are really set by the market, and having a big group doesn't really help me buy down those prices. But I think as important, or maybe more important, is that a lot of the best talent wants to work for folks like you. They can have more say in the operations. They can feel more connected with ownership. They can really invest in the community. They can have an entire career in their hometown if they want. And so I think the smaller operators have been able to retain some of the best talent, and we still know that that's critically important to operations today. Another big reason is some of the public companies upset the OEMs when they try to grow too quickly. Maybe they broke some of the stores they bought. Maybe they didn't want to invest in all the shiny new facilities that the factories wanted. So the factories created these framework agreements that really restricted the ability for public companies to grow. Yes?
This is a comment that maybe you can comment on. It says there's another angle to sellers, small sellers or single sellers. Some have to sell due to age and kids with no interest. Their hands are being forced.
There's the first part of that was there's another angle for sellers because they have to sell because they're getting older and they have no heirs or children to take over the business.
Correct.
Yeah. So I'm going to respond to that in another couple slides here because I think it's an important question. Next slide, please.
Then I do have something that's more appropriate to what you were just talking about. Do you believe OEMs will relax framework agreements enough to allow for super consolidation?
Okay, so the question is, do I believe the OEMs will release the framework agreements to allow for super consolidators? And I'm going to have some data that I think could support that. So I think the pandemic has changed some of the outlook for the public companies. Remember I asked, why did they all of a sudden start to buy so many dealerships? And by they, I really mean Lithia and Asbury. Sonic also bought a large group of stores. I know the other public companies are going to grow as well. But e-commerce has always been something we talked about in our industry, but it never really happened until the pandemic. And it was really Carvana, you know, that kind of kicked a lot of us in the butt and showed what was possible, that there's a demand for people to spend $20, $30, $40,000 for a vehicle sight unseen. If the convenience was there, if they thought the value was there, they had trust in the retailer, it could be delivered to them, it could be financed by them, they could take the trade-in. I mean, that's a breakthrough. That was a breakthrough for many consumers who were comfortable in transacting that way. So this shows e-commerce retail sales as a percentage of total sales. It went from 10% to 16% in 1 year. That's massive. Now, it's dipped down a little bit, but it's still trending back up. So I think that consumers have demonstrated they're willing to purchase vehicles online. In fact, some, like my kids, I've got 4 children, they're all in their 20s. 2 would like to go down to the dealership, try it, negotiate a deal. The other 2, they're going to press buttons on this phone to get transportation like they do for everything else in their lives, for an Uber, for DoorDash, for an Amazon delivery, whatever it is. They're used to pressing their buttons and getting something that they can buy that suits their interests, their needs. And if you take the next slide, please, look at the growth that Carvana's had. Now, admittedly, they've had a lot of trouble and may go bankrupt, but they've sold 434,000 cars last year. There's a demand for people buying these cars online. Brian's gonna be here. We're gonna talk about Driveway. Look at the data that they have in their investor presentation. 59% of people have said, I'm interested in buying a car entirely online. 96% of the people coming to Driveway were not Lithia customers. If this is not the definition of conquest, explain to me what is. Average vehicles being shipped 896 miles. They're looking at 40,000 shop and sell transactions. These are not just individual people coming to the website and then going to the store to buy, right? They're transacting on this website. So they're 1/10 of where Carvana is. But if you listen to Brian and you listen to the way that they issue their press releases, it's Lithia and Driveway. Lithia and Driveway bought the store. Lithia and Driveway released earnings. That Driveway brand is going to become the consumer brand, I believe. And they're going to continue to invest and focus on satisfying 59% of those customers that want to buy cars online. This is how I think the larger groups are going to differentiate themselves. They're going to have massive inventories. I went onto the Driveway site last night. They have 48,000 cars available for purchase on their website, almost 50% new and almost 50% used. Okay, that's a significant inventory. I don't know that there's another dealership group in the country that can offer that truly online. Frictionless commerce. It's all one price. You can do your trade-in with them. You can get financing through them. They have their own finance company, so they control that. They're not sending it off to a third party and hoping to get a good rate. And because of this lack of inventory, we're training customers. Don't go to the dealership. There's nothing there to buy. Go online. It's not worth it going down to the dealership. So this pandemic we had has jacked up our profits, but it's also changed consumer behavior. And the groups that recognize that, I think, are going to take a lot of share in the future. Next slide, please. So their strategy is a bricks to clicks. I should call it bricks and clicks. And this strategy is not a new one. But Lithia wants to have a nationwide network of stores to be within around 100 people of almost every consumer in the US and sell and service as you normally would in that area, but then use Driveway to penetrate far outside their normal sales area, right? I mentioned that the normal car is being shipped 896 miles. So you can begin to see where if you have the technology, you might not need the best talent. I mean, does Target have the best managers of stores compared to you? Probably not. But Target is buying the inventory and shipping it to the store and pricing and advertising it. The manager just needs to put it out there and staff the store and let people, help people out when they're in there. So this pandemic has transformed the growth objectives for at least 3 of these publicly traded companies. And I say the pandemic married with changing consumer behavior, married with technology where you really can sell cars. Lithia has a $50 billion revenue target by 2025. Asbury's got a $32 billion revenue target by 2025. Sonic's got a $25 billion revenue target by 2025. This is either double or triple the sales volume they had at the time they made these announcements. So this bricks and clicks strategy, I got this right here. This is the annual report from AutoNation in 1999. Don, I know you're in here. There's probably some other AutoNation alumni. But this strategy of satisfying the customers that want to come and shop locally while also satisfying customers that want to purchase online, it's taken 24 years for it to actually come to fruition. So that business plan I wrote might actually come true one day. Next slide, please. Clicks is not enough. Bricks and clicks, I think, works. Clicks is not enough. And Carvana's had what a roller coaster, right? They were the darling. I think they had a $98 or $100 billion market cap, more than all the publicly traded franchise retailers combined. And then a massive implosion as investors lost confidence that they could retail cars profitably just online. So what I like about this strategy is that old-fashioned brick, right? Because what happens in those bricks is a lot of service work gets done. You're able to acquire vehicles much cheaper than going to auction and raising your hands. There are a lot of benefits for the franchise business model that a click, a mouse, and by the way, this is when the mouse had a little string on it. That's how old this is. So clicks is not enough. Next slide, please. Public company towards progress. They have a long way to go. Right? The blue bar is where they are now. The red bar is what they need to get. So there are, let's see, 21, 37. They need about $50 billion in revenue. Next slide, please. Okay, there it is, $48 billion left to go. If we assume they're going to buy, rooftops that are mid to large size, $100 million on average per rooftop. They need to buy 489 stores to get there. That's 163 a year. Now that assumes that all their growth is going to come from acquisitions, that they won't use their existing stores to penetrate and take share. So I'm just assuming same store sales on the other ones. This growth is going to come from M&A. So you've seen this chart before about the actual sales up to 2022. Last year we think 533 stores were sold. For the public companies, they hit their goals. And if private buyers continue as they have been, we're going to be seeing an estimated 662 rooftops per year trade over the next 3 years. Now this math may be off. The retailers could just change their minds and says, it's better for my shareholders to buy back stock. I'm not going to be buying stores. But if they follow through on their plans, and if the people in this room continue with your plans, M&A is going to be going big time for the next few years. So that person, next slide, please. So how to secure your future? Next slide. The good news is there's nothing proprietary. This business plan from 1999 or the bricks and clicks, right? Anybody can do it. Now it takes money. You're going to need to acquire more franchises. The average dealer today has 2. That's not going to be enough, I don't believe, to make it for that question. I think it's going to be a challenge to have enough inventory to show people. It's going to be a challenge to drive people to your website or to your physical dealership to compete with the people that have more inventory and more locations. I think you're going to have a hard time attracting and retaining the best talent. If somebody coming out of school and goes, well, I could work at Lithia, they've got 400 stores and the best website in the business, and they're growing and there are opportunities for me. Or the person that has 2 stores, they may choose to go a different direction than they have in the past. But you can invest. If you think about, if you're 2 stores today, you think about buying a store a year, you can build a defensible platform in less than a decade. I have this phrase here about acquiring more stores locally. Another dealer, friend of ours, Don Flo, says local scale matters more than national scale. If I have 250 stores in 250 cities, I think I'm weak 250 places. If I have 250 stores in the same region of the country, I'm going to be the dominant player. I have this phrase, think Monopoly. When you land on a property, buy it. Do you guys remember when you were learning Monopoly when you were a kid and you lost every single time? I mean, I did that because I didn't want to buy the yellow properties. I want to save my money for the blue properties. And then I realized, I lost. But if I bought a property every time I landed on it, I had a chance of winning. I think it's the same thing. If there's a business that's in your area, a Toyota store, for instance, or a Mercedes store comes up for sale, the odds of you having a chance to buy that store again in your lifetime are very low. So if there's a store that fits your strategy, in my opinion, you buy it. Talent can be your secret sauce. I still feel like entrepreneurs today want to work for the owners. If you're a general manager, you have a chance to get equity in a store, you can work directly with ownership, that's an advantage for you. And I would take advantage of it. I like the equity program that many retailers have. And I'd say be a giver in your community. I mentioned that because our client here, here with Jack and Robin Salzman, gave a tremendous amount of money to the local community. And they didn't do it expecting a return on investment, but they certainly got it because a lot of people in that community realized what that dealer did for the local dealer. I compare that with AutoNation. It's given a lot of money for breast cancer research, but that's a little bit up in the clouds. The people in the community don't necessarily feel that. Because suppose if you're a local dealer and you can provide money to the church, to the schools, to the sports agency, to whatever local charity is that matters to people in that community, it has a big impact. Local scale is greater than national scale. Most of your brands are better known than Lithia or AutoNation. Continue to invest in that. This is a simple thing, but a large local inventory is a lot more valuable to customers than a big national one. They'd rather not have a car be shipped by 900 miles. I still think that local dealers can better attract and retain talent. We like the folks that have a training program where they recruit kids out of high school or college and offer to train them and offer to promote them and have them start and end their careers in the same company. And I still think most OEMs prefer entrepreneurs to the mega dealers. Mark Lenave's in here, right? He's a retired former executive, many know him from General Motors and other places. Is that last comment correct? Off the record?
Correct, except I agree with Don for local scale means a lot.
Okay, so if you have a Toyota store anywhere in the country, you're probably going to be fine. If you have a high volume single point store, if your competition is not too tough and you really invest in it, you'll probably be fine. But if you have a typical dealership in a typical town, my concern is that you slowly bleed share away to the larger groups that have these capabilities that you can't offer to your customer. You may not, it won't be an overnight thing, it'll be a gradual shift. So to that question, if you have one or two stores in a market and you don't have heirs or whatever, should you sell it? That's a personal question, of course, but the values right now I know are very high. We may not come back to this level of dealership values again in my lifetime because I think they're slowly going to go down. So I don't think the values will go up a lot. There'll be certainly good cash flow coming out of the stores, but certainly a lot of people have decided that now is a good time to go. I don't think that this shift in market share from smaller dealers to larger dealers will happen for quite a while. But the public companies that have this bricks and clicks strategy, that's what they're betting on, and that's what the investors in those companies are betting on, is we can buy this physical infrastructure and then take share from smaller dealers using my technology. So I think I won't replace this again, but I think I encourage this concept of evolution from a dealer to an investor, right? You're not selling cars today, you're really building a company. Three reasons to do this. One is protect what you own today. Second is, if you're reinvesting that capital, you're going to grow your cash flow. And the third is, if you can develop the dominant platform in any town, if you own the 10 or 20, 30 stores in a town, if Lithia or AutoNation or somebody else wants to come into that town, it's going to be very hard for them to compete with you. They're more likely to knock on your door and say, could I just buy your entire company, rather than trying to start from scratch and buying one store, two stores at a time. So we've seen the larger deals get higher multiples than the smaller deals because of that reason. A consolidator can come into a market like a Boston or Dallas or wherever, and I can assemble several $1 billion of revenue in one transaction. I'll pay a higher price for that than buying 20 stores that are doing $100 million a piece. So fewer caretakers for the folks out there, and think more empire builders. I think that is it. I think we're pretty much at our end. Any quick questions before we're done?